We've got another economic study for a proposed lithium operation. But unlike recent studies we've covered, this one is one of the premier projects in the space. PMET Resources' Shaakichiuwaanaan project in Quebec, which, if you're a bit out of the loop here, used to be known as Patriot Battery Metals and their Corvette property. It's one and the same. And while this may be one of the premier stories within the lithium sector, it seems PMET has fallen victim to the same old story typical of this area of mining, using metals prices that are hardly relevant to current markets. What else is new? Let's dive in. PMET Resources has released a feasibility study for their flagship Shaakichiuwaanaan project in Quebec. And while recent resource estimates have indicated that tantalum and gallium exist within the deposits on site as well, alongside cesium, this study is much narrower in focus. Instead of studying the merit of the development of the two major deposits on site, CV5 and CV13, and all the minerals they have to offer, PMET instead took the path of least resistance by electing to focus only on CV5 and only on the extraction of lithium. The strategy behind this focus appears to be twofold. First, the narrow band of focus enables the company to be able to get operations up and going because what is important here above all else is the path to revenue generation. Secondly, it streamlines the approval process with government agencies and local communities. Once the lithium extraction op is up and running, PMET will then work towards the processing of other minerals that are contained within the ore. In the interim, the feasibility study outlines an operation with enough processing capacity to enable maximum optionality and flexibility down the road, while at the same time, PMET intends to conduct the MET work required to support the development of a bolt-on recovery circuit for tantalum, while also advancing work on what they refer to as the cesium opportunity. The feasibility study here, of course, follows up on a preliminary economic assessment published by Patriot back in August of 2024, which quite frankly is an incredibly short timeline to go from PEA to feasibility. But it isn't exactly a rosy comparison. Well, we all expect PEAs to basically outline a best case scenario and for economics to get worse as things move along the development timeline. Things got markedly worse here, like feasibility study pre-tax NPV being lower than PEA after-tax NPV worse. And on that note, let's get into the details. PMET's feasibility study for their flagship project proposes a lithium mine that would operate for a total of 19 years, with nameplate capacity of 800,000 tons per annum of spodumene concentrate production. Much like what was outlined in the PEA, that capacity is to be achieved over two phases, with Phase 1 operations to consist of open pit mining methods with an initial capacity of 400,000 tons per annum of production, while Phase 2, which consists of an underground mine, will double that capacity to 800,000 tons per year once online. That expansion is expected to see work get underway in year 1 of operations, with the first ore to be delivered in year 2. But this is where things already start to get worse relative to the PEA. Under the PEA, open pit Phase 1 construction and ramp-up was estimated at just 2 years. Under the feasibility study, that extends to 2.5 years or as much as 3.4 years, depending on whether you want to mark breaking ground or the detailed engineering phase as the starting point. And the underground expansion is now to take 3.6 years from start to full ramp-up versus the prior 2-year estimate. Oh, and the mine life has been shortened from 24 years under the PEA to now just 19 years. The bright side here is that well over the life of mine for the open pit, total tons mined drops from the prior 239 million tons to 217, and the strip ratio goes from 3.7 to 3.4. On the underground side, total tons mined increases slightly from 39.8 million tons to 40.3. In terms of processing, nominal process plant rates have been estimated at 5.1 million tons per annum, but the actual average process plant feed rate over the life of mine is estimated at 4.4 million tons per year. Feed grades, meanwhile, are estimated at 1.26% lithium versus the prior 1.31%, leading to expected recoveries declining from 69.5% to 68.9%. Over the life of mine, actual average spodumene concentrate production rates are estimated at 694,000 tons per year, with total life of mine recoveries of 13.3 million tons, which is also down from the prior estimate of 14.9 million tons under the PEA scenario. So what do the dollars and cents look like here? Well, PMET has put forward one of the more complex forms of costing that we've ever seen, which is a function of the different phases they intend to use. Initial costing under the feasibility study here includes all of the initial costing of Phase 1 plus some initial costing of Phase 2. And then there's a separate portion of phase 2 operations that has been deemed to be expansion capital, resulting in multiple different cost buckets for this lithium project. Overall, total initial capital costs are pegged at $1.5 billion, of which $1.3 billion is attributed to phase 1 expenditures, while $148 million is associated with phase 2 expenditures. Comparatively, the PEA outlined just $761 million in initial capex. But then we need to add in a number of reductions, including $102 million in pre-production credits, $210 million in CTM ITC tax credits, and $43 million in TCRR tax credits, bringing total initial capital on a net basis down to $1.1 billion under the feasibility study. Expansion capital for the Phase 2 underground then adds a further $481 million to total development capital costs, but tax credits bring that down to $367 million. Overall, total development capital costs on a net basis come out to $1.5 billion. Sustaining capital costs, meanwhile, come in at a gross $936 million, which is also subjected to a series of tax credits, bringing estimated sustaining capital down to $886 million. The PEA, meanwhile, had suggested this figure would sit at $638 million on a net basis. And for those curious, total tax credits over the life of this project are expected to amount to over $500 million at $519 million. In terms of operating costs, things here are actually in good shape under the feasibility study relative to the PEA in this regard. Cash operating costs at site sit at $511.90 per ton of spodumene concentrate versus the prior $510 estimate, while total cash operating costs are down to $729.10 per ton versus the prior $736 per ton estimate. All-in sustaining costs, meanwhile, increased to $799.80 per ton versus $780 under the PEA, but that's a rather small increase relative to the increases we saw on the capex side of things. But where things really take a turn, at least in comparison to the PEA, is the overall economics of the project. Under the feasibility study, PMET used a spodumene price of $1,221 per ton of 5.5% spodumene concentrate. The PEA comparatively used $1,375 per ton pricing. Obviously, this had an impact on the economics here. Not to mention the fact that spodumene last traded at about $854 a ton on spot markets, which is only slightly above their expected AISC. On an after-tax basis, using an 8% discount rate, the Shaakichiuwaanaan project is estimated to have a net present value of $1.59 billion under the feasibility study, versus $2.9 billion under the PEA. After-tax IRR, meanwhile, has dropped down to 18% versus the prior estimate of 34%, while the payback period has climbed to 4.7 years from the prior 3.6-year estimate, which really isn't all that positive. But that doesn't really seem to matter to PMET for some reason, who is bound and determined to get this thing to production, referring to the project as having the potential to be among the top 4 spodumene producers globally. The feasibility study here was completed as part of a requirement under an environmental and social impact assessment that is required prior to receiving final permits for the mine. Moving forward, PMET intends to advance things to detailed engineering to assemble a development pathway that is aimed at maximizing long-term value. Next steps as part of that process include an underground bulk sample, while also working to advance discussions with customers, strategic investors, and the government. In parallel, PMET also, of course, intends to continue exploring at both CV5 and CV13, while analyzing opportunities for both tantalum and cesium, which could work to improve project economics. A final investment decision is expected to be made in the second half of 2027, which is a result of provincial permitting expected to take 18 to 24 months post-final submissions. All right, so let's wrap it up. Are the economics of this project fantastic? Well, if we use the current prices of spodumene concentrate, no, they're not. We can basically throw the NPV out the window. But here's the thing. And I was recently tweeting at Jody DeRouge, who's one of the big names behind this project, about why things move forward in China and why they don't in Canada. And that's because if China wants something to move forward, the economics don't really matter. The government will fund it. Of course, they have end users to sell it to and a command-based economy, but this is how the Canadian government needs to start thinking if they want these projects to move forward. These little investments here and there are not going to move the dial. Right now, Mark Carney, the Liberal government, and the Canadian media, which is largely funded by the Liberal government, I think we can all acknowledge that, they won't stop talking about lithium. It seems like the perfect opportunity to come out and make a statement and make a big investment in some sort of lithium project, and PMET is clearly at the front of the list. They've already done it with a project, Frontier Lithium, I believe, in Thunder Bay, which is a processing facility. I don't think that they're giving them nearly enough money. That's why I'm critical of that one. In this case, I would like to see the federal government step up. Forget about permitting for a second. Let's put some money into this thing and make this thing happen. If we're serious about lithium, it's going to require a long-term vision by the federal government to work with PMET to make this happen. Whether that happens, time will tell. But I actually think that that is the end game scenario here. All right, everybody, thanks for watching. If you have comments on what I just said or other stories you want us to cover, as always, let us know in that comment section. If you want more mining content, check out our website over at thedeepdive.ca. And if you enjoyed this video, do me a favor, smash that like button, subscribe, and ring that notification bell. All right, everybody, thanks for watching.